Video specifically for those of you who are looking to sell the home that you are currently in and you're wanting to upgrade, but you're just kind of maybe crapping your pants because you're in a really awesome interest rate at the moment and it feels really terrifying to give that up, but you know that just your house no longer works for you, or you are being forced to move given like a life change, you're moving, you have a new family member, or something along those lines. By the way, if we haven't met, my name is Chelsea Winstead. I am a home financing strategist and a mortgage lender. I help people financially plan, strategize, and put into action the best case scenario in order to make this happen with the least amount of pain as possible. Okay, so let's talk about a few ways, first of all, to navigate wanting to upgrade, but really feeling like stuck, and for good reason, in a home that you purchased for 2 to 3%. So the most obvious option that you have access to is to sell your current home to another person, right? And then use that equity that you have in order to cover things like a down payment. Another huge thing, I've probably helped 3 or 4 clients do this recently, where just over the years, like life has happened or whatever, like mortgage was so inexpensive that other debts started to creep up. So I've had a lot of people who, yes, their home payment is actually quite inexpensive, but their other debts, like all together, are certainly high. So like we have like a rise in credit card debt, people that have like personal loans that they've taken out. So an option that you do have is to obviously sell the current home and use the equity that you've built in that home to not only pay off personal debts that you have collected along the way, which then overall still could potentially like reduce all of your monthly payments. Also, that means that when you have this much equity, you then can put down a larger down payment on a new purchase. So like many people, when they're buying a home for the first time, most people today, statistically, are putting down the minimum. So you're talking 3% on a conventional loan, 3.5% on a FHA loan. And a lot of people are still leveraging down payment assistance programs. So sometimes that means like putting no money down. The downfall of that is that then you are truly financing the full amount, which then means that your monthly payment, given the new interest rates, are going to be a bit higher. So the fact that you have purchased a home, assumingly if you are in a 2 to 3% range, you have probably gained a significant amount of equity on that property, which then just means that you're going to have a larger chunk of revenue available to cover and maybe put down more money on a home, which then would mean that, right, like your monthly payment would be less. So one option that's probably the most obvious is that you can sell your current home and you can utilize that equity to not only put a bigger down payment, however, you can also use that to pay off other debts that you have collected along the way, which then could hypothetically lower your total monthly payment, even if you are getting into a bigger and better home. Okay, now option number 2, which is like a really popular one that I see a lot of people do, is that you can actually, so let's say, right, you still own this home that's between 2 to 3% and it's not working anymore for whatever number of reasons. And you want to buy a new house and you're again, like you're fearing like letting go of not having access to this original house. Another option that you have access to is that you can actually utilize a HELOC, so home equity line of credit. You can pull a HELOC from your current home that you own, and you can use that cash to then pay for the down payment on a new home, okay? Key thing, obviously, is that at this point, let's say like you're doing this with no anticipation of selling your current home, you obviously will then have to qualify for like both mortgage payments. A lot of my clients are able to do this. And so this debt to income ratio would include like existing mortgage payment if you have one, new mortgage payment, and then obviously like the monthly HELOC payment. Not like this doesn't work for everyone. However, I think that a lot of people don't realize that like utilizing a HELOC to then leverage equity on your current property allows you to make a move into a new home without having to like completely sell out and sell the existing property that you own. Another thing that you can do is if like even through this process, and specifically if like the debt to income ratio is a concern, like qualifying for both mortgages, you can get a renter inbound to your new home. So lease agreement, security deposit, and first month's check would allow us to then utilize that rental income on your existing property to then offset that debt to income ratio. So that's also another huge option that people have access to, which is again, like keeping an existing property. Okay. Option 3, which again, if you bought in the 2 to 3% interest rate era, this is probably, in my opinion, it's a little more logistically challenging, but it is certainly not impossible. And I think it's actually like a really phenomenal choice for those of you who want to have some type of investment property in your portfolio by so you keep your current home and use this as a long-term rental. My assumption is that if you've bought a house that has a 2 to 3% interest rate over the past 5 years, it has increased in value tremendously, which means that if you own a home that you bought that has an interest rate of 2 to 3%, you can rent that out. Like that is a super rentable property because your mortgage payment is probably down here and the current market that you live in, you probably could rent it for up here. So now what you have in between here is monthly income. That monthly income can be either you use that to your, like however you like, put it in a savings account, whatever, put it like whatever you want to do with that. A lot of people, though, can then use that extra profit that you're making every month between what the mortgage cost and what you could rent the home for. They're taking that net profit and they're using that to then help offset the new cost of their new home. Y'all, the reality is that we are not going to see, let me say this. Clearly, none of us saw the worldwide disaster that happened, which is why we even saw 2 to 3% interest rates in the first place. Could something like terribly bad happen and put us back where that why that happened? Yes, but the likelihood isn't very high. That's why it was deemed as historically low rate. So the reality is that unless you are down to literally live in your current 2 to 3% home forever, like you've just confirmed that it's going to work for you, you are going to not only pay more for a house payment, like pay more for a home because homes are just more expensive now than they were in 2020, and rates are higher. So it's more about coming to the realization that that's not going to change. Whether you like it or not, we are in a different world than what we were back when you bought that initial home. And that is like a decision you have to make. The reality is like I literally help hundreds of people every single month go through this process and move forward on buying something that now works for them. That choice is yours as an individual. You have to make that choice. If you know in your heart of hearts that your current home that you bought at 2 to 3%, while it was a great deal and a great gig, it's no longer working for you, what you really need is somebody to help you run the numbers. I think that in and of itself is what trips up so many people is when you bought something super cheap and for a super low interest rate, it feels like when you watch everything and read everything that there is just like no way for you to move forward. And the reality is that that's not true. Every single day I work with people that come inbound and they're in a current home that they bought at 2 to 3% interest for really inexpensive. And they say to me, what choice do I have? The reason I call myself a strategist is because we strategize. We look at options. We look at the difference between, okay, what happens if you keep the current home? What happens if you keep the current home and use the HELOC? What happens if you keep the current home and you rent it out? What happens if you sell the current home? What kind of equity are you going to have? Like we run different scenarios. And each scenario is based on a personal situation that you are navigating. But the reality is that you don't know what you can do unless you run the numbers. And more often than not, y'all, you know what people tell me? Oh, that's actually not that bad. Or, oh, we could actually do that. Or, oh, I didn't realize that with that much equity, this is what this would allow us to do. And I think that's the reality is like there's so much fear mongering that happens on this damn app that people just get so psyched out and feel like they're stuck. Now, if you make a choice that you don't want to leave, again, that's on you. And again, my agenda is not to convince anyone otherwise, but what I do help is people who know that the home doesn't work and they need to figure out a solution, but they feel stuck. If you feel stuck, what you need to do is talk to somebody who can help you run scenarios and give you recommendations on how to best move forward. So if you live on the East Coast and you are in this predicament of being stuck in a 2 to 3% home and you are interested in learning what options you have, let's have a conversation. Link on my profile to fill out a connection form. I will send you a text. Let's run the numbers because you may just be damn well surprised that it's not as bad as you think. All right, y'all. See you tomorrow.